video is going to be about depreciation. Depreciation is cost allocation for expense recognition. When we talk about expenses, we're talking about costs that we incur in order to generate revenue. Most of the time, expenses are things like salaries and utilities and things like that. But depreciation is also an expense. In order to abide by generally accepted accounting principles, we need to record our depreciation expense according to the expense recognition principle. Expenses are to be recognized or recorded when they are incurred and matched to the periods in which they help a company generate revenue. And that's why we also refer to this often as the matching principle. Revenues from a period need to be matched up with the expenses from the period. What does incurred mean? We said expenses are to be recorded when they are incurred. Well, expenses are incurred when the activity that results in the cost happens. So we're going to talk about depreciation in particular in this video. We're not going to really touch on other expenses, but it's important that we remember the expense recognition principle. What is cost? Well, if we look at the dictionary, cost is an amount that has to be paid or spent to buy or obtain something. The effort or loss or sacrifice necessary to achieve or obtain something. Allocation, according to the dictionary, means the action or process of allocating or distributing something. So we have cost, what we've paid for something, and allocation means distributing. And so what we do in accounting with depreciation is that we allocate, distribute, the cost we've incurred for long-term assets. One of my favorite movies, right here, a picture of Teenage Mutant Ninja Turtles 2, The Secret of the Ooze from 1991. Here you see the Teenage Mutant Ninja Turtles fighting over the allocation of pizza. Raphael has the pizza and does not want to share. He does not want to allocate or distribute it amongst his brothers. And so, I just thought that was fun to put in there. So, cost allocation. Let's say that we're a florist and we're going to purchase a new van to deliver flowers in. That van is going to provide us with revenues, or help us, I should say, generate revenues, we think, for the next 4 years. 2020, 2021, 2022, 2023. So we expect this asset that we've purchased to provide us with revenues for the next 4 years. If we are going to appropriately match our revenues and expenses, then we should expense this asset, this vehicle, over the next 4 years. Each period expensing an amount that could be matched to the revenues that this vehicle has helped us to generate, thereby abiding by the matching principle. So, first thing that we need to know about depreciation is that cost allocation is not valuation. We are not trying to determine what this delivery vehicle is worth to other people, what it's worth on the open market. That is not what we're doing when we're doing depreciation, even though many people think of depreciation as the loss of intrinsic value of an item, which is also an okay use of the word depreciation, but it's not what we're doing when we're doing this for accounting purposes. Number 2, determining book value, as I said, is not determining market or fair value. And third thing, how? How can we do this? How can we spread this cost out, distribute this cost, allocate this cost over the periods in which it helps us to generate revenue? Well, we have multiple ways to do that. We'll get into some of those later. So when we look at depreciation, the first thing we need to really discuss is that there's two different ways to do this. You have depreciation that must be recorded for GAAP purposes, generally accepted accounting principles, and for tax purposes. We have to do it for GAAP so that we can record and prepare our financial statements. We have to do it for tax on our tax return so that we can determine the appropriate taxable income for our business. Now, for GAAP purposes, the Financial Accounting Standards Board says we're doing this for expense recognition. And you've got 4 different ways that you can do it. You're going to determine the useful life. The company is going to determine the useful life of the asset. And they're going to determine the residual value of the asset. When we look over at tax purposes, again, the main reason is to calculate taxable income. And the depreciation methods allowed are declining balance or straight line, but it depends on the type of asset. The useful life is not determined by the company. The useful life is determined by the Internal Revenue Service, or the IRS, using the Modified Accelerated Cost Recovery System, or MACRS, as it's referred to. And the residual value, there is no residual value. When we use depreciation for tax purposes and calculate depreciation for tax purposes, there's no residual value as part of the calculation. So we have some pretty significant differences here between tax depreciation and GAAP depreciation. Now, if the amounts of difference, the dollar amount of difference between taxable and GAAP, right, is insignificant, some companies will use their tax depreciation amounts calculations for their financial statements. And that's okay, but it depends on the scenario. So let's talk about GAAP depreciation. Most of our discussion here is going to be about GAAP depreciation. There are components to the calculation of depreciation. First, we have to know the cost of the asset. Then we have to know the depreciation method. We have to know the useful life, and we have to know the residual value, or what's sometimes referred to as the salvage or scrap value. The cost of the asset is going to be any costs that we incur to acquire or prepare the asset for use. Those costs are going to be capitalized, meaning they're going to be recorded as part of the cost of the asset. So it's not just the amount we pay for the specific asset. There can be other costs that are included as well. If we have to pay for decals to be put on the van, or the delivery vehicle here for our florist, if we have to pay for decals, those would be considered a part of the cost of preparing it for use, and so it would be included. If we had to have the engine overhauled for some reason, those costs would likely be added to the cost of the asset. Now, what happens if we buy a bunch of assets in a lump sum purchase? When a company purchases multiple assets for a lump sum, meaning the values of each individual asset are not identified, the company must use the relative fair market value to determine the cost of each asset. Now, when we look at the calculation, first thing we want to know is what the depreciable base is for the asset. The depreciable base is the total amount that's going to be expensed or depreciated by the company. We determine the depreciable base by taking the cost of the asset and subtracting the residual value, whatever we think the asset will have for a value when we are done. The depreciation methods that we have at our disposal under GAAP to choose from are straight line, units of production, And then we have two accelerated methods, the declining balance methods. There's a couple different ones of those, and sum of years digits. What's important to remember is that each method will result in the same amount of total accumulated depreciation, and the same accounts are going to be debited and credited regardless of which depreciation method we choose. Now, when we make this journal entry, it is an adjusting entry. Adjusting entries are made at the end of the period, whether we do these entries monthly, or we do them quarterly, or we do them annually. The journal entry that we're going to record is a debit to depreciation expense and a credit to accumulated depreciation. Depreciation expense records the amount of expense that will show up on our income statement for the period, and the accumulated depreciation, which is a contra asset account, records the amount of the depreciable base that we have depreciated up to that point. Since it is a contra asset, it's going to be contra to our equipment or our buildings on our financial statements. We cannot credit the equipment or the buildings account, even though we're expensing them, because we still have those assets, and assets have to be recorded or reported at their original cost in our records. So the contra asset account is used to show to offset those cost values. And so that's how we determine the value of the asset in the books, which we call the book value. The book value is the amount yet to be depreciated, and it's the value in the books, which is why we call it the book value. The book value of an asset is equal to the cost minus the accumulated depreciation. Another thing that's important to remember is that book value is not market or fair value. We said this before, but oftentimes it needs to be repeated. So the book value, which is the value on my financial statements, is not what people in the marketplace would be willing to pay me for those assets. Now, if I'm in a manufacturing business, depreciation is a little bit different. In a manufacturing business, depreciation depends on whether it is for factory buildings and equipment or buildings and equipment for administrative and selling use. If I have factory buildings and equipment that I'm depreciating, that depreciation is considered a product cost. The factory buildings and equipment are used to make the products, therefore the product cost classification. Those buildings and equipment that I use for my administrative purposes or selling purposes are considered a period cost. And they are not a cost incurred to make the products. And so what happens with these two costs? Well, when depreciation is recorded for factory buildings and equipment, it goes into my inventory because the value of the products I'm producing, right, is has a component in that value of my expensing the depreciation on the factory buildings and equipment. Since it's a product cost or a cost of making the product, it goes into inventory, and then it will be expensed through cost of goods sold when the inventory is sold. The depreciation on buildings and equipment for administrative or selling use goes straight to depreciation expense. That's the typical entry that we have seen in most of the coursework that we take in accounting. And so when we look at these two journal entries, both of them will be crediting accumulated depreciation. But for factory buildings and equipment, we debit manufacturing overhead, which eventually ends up in inventory and then gets expensed through cost of goods sold. For buildings and equipment for administrative and selling use, we see our typical journal entry, the depreciation expense and accumulated depreciation. Now, what does this look like on balance sheets? If we look at the Home Depot's balance sheet, we have the asset section here. You'll see net property and equipment. They give us the amount for the end of 2018 and 2019. Here we have the end of 2018, which is the February 3rd date on the far right, and the end of 2019, which is the February 2nd, 2020 date to the left. And so we have net property and equipment. Now, what they're showing us here is the book value of all of the property and equipment. Not the market value again, but the book value. That's not very detailed. But this is what most companies do. And what happens is, in the notes to the financial statements, after the financial statements and the annual report, they will show you some more detail. So in note 3 for Home Depot, here they break out all of the different kinds of property and equipment. So they give us land, buildings, furniture, fixtures, and equipment, leasehold improvements, construction in progress, finance leases, and they give us then the total property and equipment at cost. Then they subtract the accumulated depreciation and give us the net property and equipment that we see on the balance sheet. So even if it's not on the face of the balance sheet, they'll give us more detail often in the notes. So that was Home Depot's. Here is Lowe's, just for a comparison. Lowe's has property less accumulated depreciation on their balance sheet, which is the same as net property and equipment. And then, in their note 7 here, they give us the cost of their land, their buildings, their equipment, and their construction in progress. They give us total cost, less the accumulated depreciation, and then they have property less accumulated depreciation, which is what we see on the balance sheet. Lowe's here also gives us estimated depreciable lives or estimated useful lives in their note. So when we look at the balance sheet, we're looking for property and equipment less accumulated depreciation is what we typically see from a company. There's often more detail, like I said, in the notes, but the balance sheet usually just has one line related to these items that we're talking about.